Hey guys, welcome to the Max Invest YouTube channel. In today's video, we're going to be talking about a few different things happening in crypto. We're going to be talking about the liquidation event that happened last night. We're also going to be talking about Defi 2.0 and what I think of it. And then I'm going to discuss a few things regarding the graph. Of course, if you enjoy the video, remember to like and subscribe to the channel, follow me on Twitter, join the Discord channel, the links are down below in the description, and remember, nothing in this video is financial advice. So let's get into the video. Now, the first thing that I wanted to discuss is the big liquidation event that just happened last night. As we can see, roughly $500 million of liquidations occurred. Essentially, this happens when individuals start selling. This selling pressure drops the price. People start getting liquidated who are leverage trading. These liquidations drop the price, and then more and more people get liquidated. Now, this liquidation event wasn't actually that big. $500 million is pretty small relative to the other ones, and that's why we only saw the cryptos drop roughly 10% on the day. So it wasn't too bad, nothing that I'm too worried about, and I think everything is fine in this matter. Of course, another thing that I do want to briefly discuss is a couple of days we saw that Chainlink longs were loading up and people were starting to leverage up on Chainlink. All of these people have now been liquidated, so these people actually didn't know something. This is why looking at Chainlink longs and Chainlink leverages isn't always the best indicator of future price movements. Sometimes it may be a good indicator, however sometimes they could all get liquidated and the price could drop over 10%. Something interesting to note. The next thing that I wanted to talk about is Defi 2.0. Now, Defi 2.0 is quite interesting. A lot of people are saying that this is marking a new era of DeFi on the Ethereum network, and a lot of other people are saying that DeFi 2.0 is more or less scams. Now, in my opinion, it's probably somewhere in the middle of these two. DeFi 2.0 definitely does bring a lot of different things to the table. However, a lot of this new stuff coming out does look a little bit shady, and I'm not quite convinced on some of it just yet. Now, the important distinction is that DeFi 2.0 is a bunch of protocols that are trying to do something a little bit differently to old DeFi. Essentially, with old decentralized finance, a lot of the incentives would be liquidity mining programs. Protocols would offer individuals extra money to come in and start mining and start farming. They would offer individuals rewards on top of what they're already doing to get more and more users on the protocol. This is usually made possible by certain protocols having a token that they issue out to individuals and then giving this token some form of value so people buy it up. The problem with this model is that it can attract mercenary farmers. Individuals come in, they start farming, and then they dump the tokens directly after they farm it, dropping the price. Now, DeFi 2.0 is trying to do something a bit different, where it is protocol-owned liquidity. This means that instead of individuals owning their own liquidity, the protocol actually collates all of the liquidity and it owns all of it. Of course, I don't think DeFi 2.0 is a replacement for DeFi 1.0, it's just trying to say there's something new. DeFi 2.0 isn't trying to replace anything whatsoever, it really is just saying that this is another way of doing it, and it's sort of experimenting with that, which I do think is quite interesting. Now, there are a couple of different projects that I am quite interested that are sort of fall under the branch of DeFi 2.0. The first one is called Tokamak, and what Tokamak essentially does is it creates sustainable decentralized finance liquidity and capital efficient markets through a convenient decentralized market making protocol. Now, if you don't know what market making is essentially the business of liquidity. Market making is directing liquidity to where it's actually needed. If certain stocks or certain things need liquidity, they need money in it, well, then there needs to be money directed that way by market makers. Of course, in traditional finance, market makers are things like the Citadel, however we don't see what happens behind the scenes. In cryptocurrency, we can invest behind the scenes and we can actually see everything that's happening with these market makers in a transparent way. So let's go into how Tokamak exactly works. Essentially, what Tokamak does is Tokamak has 5 different reactors. Now, what individuals will do is individuals will deposit assets into these reactors to earn a certain amount of yield. What will then happen is certain applications on the Ethereum network will say that they need liquidity. Now, the reason that these applications may need liquidity is perhaps because they're making a new token. Of course, this new token may need some liquidity to get started. Think of, say, a decentralized video game. If they're trying to make a token on top of it, it may be really tough to get liquidity into that. So they may want to use Tokamak. As a direct result, what will happen then is individuals who are depositing into the reactors and staking their tokens will then be able to direct where this liquidity goes. This means out of these 5 reactors, the liquidity can be directed to certain applications. So if individuals want to direct liquidity at a certain video game, well then that decentralized video game will take the liquidity, use it, borrow it, and then they'll pay back these holders with a certain interest rate on top of that. So, it may sound a little bit confusing, but all this is actually trying to do is it's just trying to direct liquidity to places where it's needed. If an application needs some liquidity, well, they can get it from Tokamak. Now, I do find this quite interesting as this is a broader infrastructure play. The potential for this could be very big, and it'll be interesting to see what happens. I don't actually own any of this as of yet, however, it's definitely worth considering for me. Now, the next one that I do want to talk about regarding DeFi 2.0 is called Olympus DOW, and I am a lot more skeptical about this and I don't fully understand it just yet. However, what Olympus DOW is trying to do is it's trying to build a decentralized reserve currency. Essentially, what Olympus DOW is saying is that there are no stable coins right now. They're saying that the US dollar is impacted by inflation and uncontrolled monetary policy. Bitcoin and Ether are also not stable whatsoever, and Olympus DOW wants to come in and sort of make a decentralized reserve currency with intrinsic value. Now, the way that this works is very weird. Essentially, what happens is people buy the Olympus DOW token, and then when the Olympus DOW token gets to a certain point, the Olympus DOW team will start selling that token and putting it into a treasury. And what this treasury will then do is it'll start backing all of the tokens. This means that the token essentially can't go below a certain price. The ultimate goal of this token is that there's going to be a whole bunch of assets backing it and it won't be able to go down. So, this kind of looks like fiat money before the gold standard was removed. Essentially, fiat used to always be backed by gold, and this would give it value. However, this has since been removed. So, Olympus DAO will essentially be backed by a whole bunch of different reserve assets and different treasury assets. Now, there are a few other ways that Olympus DAO gains its assets, such as bonding programs, and there's a few different things. However, in my opinion, I am still a little bit suspicious about this protocol. It does seem quite weird and quite abstract when you really think about it. How is it going to become a decentralized reserve currency? The price of Olympus DAO is not stable whatsoever just yet. It is quite interesting, however, I'll probably need to dig in and do a little bit more research to actually see what it's all about. Anyway, those were the two main protocols that I wanted to discuss regarding DeFi 2.0. There are a whole bunch of other protocols and I may do some videos on them in the future. Now, the final thing that I did want to discuss is regarding the graph. You may know that I've made a couple of videos on the graph in the recent week, and it is a quite interesting project. Now, I don't have much of this coin just yet, however, it does look quite interesting, and I'm doing further and further research to see if it is good. Essentially, if you don't know what the graph is a data indexing protocol. So all it does is it gets all of the data, puts it in nice and clean positions, and then applications are able to use that data. It is quite complicated to think about if you aren't a developer. Now, the interesting thing about the graph is that currently you can only use it for Ethereum. However, it's expanding out into other layer 1s, such as Near Protocol. So this kind of makes it similar to Chainlink in the way that it's sort of trying to be the infrastructure behind blockchains. However, it doesn't directly compete with Chainlink because Chainlink does off-chain data and the graph specializes in sort of indexing on-chain data. So, in my opinion, I probably don't think that this market opportunity is as big as Chainlink's. However, it definitely does look very cool, and there does look like there is a bright future for this if it gets a lot of usage. In my opinion, the ideal portfolio is sort of investing in a big layer 1 that can capture a lot of value, and in my case this is Ethereum, and then investing in some of these other infrastructure and middleware solutions such as the Graph and Chainlink, as of course these are compatible with all of the other layer 1s, and these are sort of the infrastructure behind everything that goes on. Of course, I don't believe that the Graph or Chainlink can actually capture as much value as Ethereum, as I still do think that the value proposition for a good layer 1 is a little bit stronger in that you do need tokens for fees in order to actually pay for smart contracts to be executed. Regardless, I am quite interested in the infrastructure behind these blockchains, and the Graph does look very interesting. Anyway, this brings us to the end of the video. If you enjoyed the video, remember to like and subscribe to the channel, and thanks for watching the video.